The question I get asked most is the housing market about to crash? Headlines warn of soaring prices or looming collapse, leaving buyers anxious and confused. High living costs and mortgage rates make homeownership feel out of reach, especially for first-time buyers. But is it really impossible? Or is there an opportunity hidden in the chaos? I've seen booms and busts. Headlines rarely tell the full story. Even in tough markets, there are chances for savvy buyers. Today, we'll cut through the noise and look at the facts. Is a crash coming? Or is this a window of opportunity? Let's dive in and find out. To predict the future, we need to understand the present. Interest rates are at 5.25%, making mortgages expensive and slowing house price growth. The average UK house price is around £285,000, but the pandemic's rapid rises are over. Properties take longer to sell. Buyers have more room to negotiate. First-time buyers face high deposits and strict affordability checks. The market is caught between what sellers want and what buyers can pay. This tension fuels speculation. Will prices fall, or will the market stabilise? High borrowing costs are capping prices, but demand for homes remains. Understanding these numbers is key to your next move. Let's see what history can teach us. Let's rewind to just before 2020. For years, ultra-low interest rates made mortgages affordable and the market stable. House prices rose slowly. Buying and selling felt normal. Government schemes like Help to Buy helped first-time buyers. The market was steady, supported by cheap borrowing and incentives. Then the pandemic hit. Everything paused. Lockdowns froze the market, and experts predicted a crash. But what happened next was a surprise. The calm ended, setting the stage for a dramatic shift. Let's see how the market exploded. Instead of crashing, the market boomed. Lockdowns changed what people wanted: space, gardens, home offices. Demand surged as families left city flats for bigger homes. The government's stamp duty holiday fueled the frenzy. Homes sold in days, often above asking price. Bidding wars were common. Prices jumped by up to 20% in some areas. Sellers celebrated, but buyers faced stress and fierce competition. Cheap mortgages added fuel to the fire. The boom couldn't last. Eventually, incentives ended and demand cooled. Prices stayed high, but affordability worsened. The stage was set for new challenges. After the boom, inflation surged, driven by supply issues and global events. The Bank of England raised interest rates to cool the economy. The base rate climbed from 0.1% to 5.25% by 2023. Borrowing became expensive. Mortgage payments soared. Many buyers were priced out, and lenders tightened criteria. Demand dropped, slowing price growth and causing dips in some regions. The era of cheap mortgages ended abruptly. Sellers and buyers now face a standoff: high prices versus limited budgets. This journey, from calm to boom to correction, shapes today's market. What does this mean for affordability? The biggest risk now is affordability. House prices remain high compared to wages, especially after the pandemic surge. First-time buyers struggle with huge deposits and high monthly payments. Many are priced out, reducing demand and putting pressure on prices. Even existing homeowners can't always move up the ladder due to higher rates. The market slows, fewer transactions, longer sales, lower offers. Some experts say prices must fall to restore balance. Unless wages rise or rates drop, house prices are the only variable left. This is the core argument for a potential correction, or even a crash. The next move depends on how these pressures play out. Another major factor that has crash watchers worried is the wave of homeowners coming to the end of their cheap fixed-rate mortgage deals. During the period of ultra-low interest rates, millions of people locked in mortgage rates of 1 or 2% for 2, 3, or 5 years. These deals provided them with certainty and affordable monthly payments. However, as we move through 2024 and into 2025, a huge number of these fixed-rate periods are expiring. Homeowners who are remortgaging are facing a brutal payment shock, as they are forced to switch to new deals at rates of 5% or even higher. It's a financial cliff edge for many households. For a family with an average-sized mortgage, this could mean their monthly payments jump by hundreds of pounds overnight. This is a significant blow to household budgets that are already squeezed by the higher cost of living. People will have to make difficult choices, cutting back on other spending to cover their new, much higher mortgage costs. This reduction in disposable income has a ripple effect on the wider economy, as people spend less in shops, restaurants, and on services. It creates a drag on economic growth, which in turn can lead to job insecurity, further dampening confidence in the property market. The big question is whether people can actually afford these higher payments. While most will manage by tightening their belts, a minority may find themselves in serious financial difficulty. If someone's income has fallen or their circumstances have changed, they may struggle to meet the new payments, potentially leading to arrears and, in the worst-case scenario, repossessions. An increase in forced sellers, people who have no choice but to sell their home because they can no longer afford it, would flood the market with properties. This sudden increase in supply, combined with lower buyer demand, is a classic recipe for falling prices. This is the ticking time bomb that many economists are pointing to. They argue that the full impact of higher interest rates has not yet been felt because so many people were protected by their fixed-rate deals. As these protections fall away throughout 2025, the true affordability crisis will hit home. The resulting financial strain on millions of households could be the catalyst that turns the current market slowdown into a much more significant downturn. It's a serious risk that cannot be ignored when we consider the potential for a market crash. When house prices fall, negative equity becomes a real risk. It's when your mortgage is higher than your home's value, leaving you trapped, unable to move or remortgage. This can create a vicious cycle with falling prices and fewer buyers, making the market even worse. That's why it matters. Finally, the argument for a housing market crash isn't just about mortgages and house prices. It's also about the wider health of the UK economy. The property market doesn't exist in a vacuum. It is deeply connected to things like job security, wage growth, and overall economic confidence. When the economy is struggling, people feel less secure about their future, and they are much less likely to make big financial commitments like buying a house. As we look towards 2025, the UK is facing some significant economic headwinds that could easily blow the housing market off course. One of the biggest concerns is the risk of a recession, or, at the very least, a prolonged period of very slow economic growth. While inflation is coming down, the medicine of high interest rates has side effects. It slows down business investment and consumer spending, which can lead to job losses. If unemployment starts to rise, more people will find it difficult to keep up with their mortgage payments. The fear of losing your job is one of the most powerful deterrents to buying a home. A weak economy erodes the confidence that is so vital for a healthy property market. Furthermore, the global economic situation remains uncertain. Geopolitical tensions, ongoing supply chain issues, and slow growth in other major economies all have a knock-on effect on the UK. We are an interconnected world, and problems elsewhere can quickly impact us here at home. This global uncertainty makes businesses and consumers cautious. When people are worried about the future, they tend to save more and spend less. This cautious behavior directly translates into lower demand for big-ticket items, and there is no bigger ticket item for most people than a new home. So, when experts predict a crash, they are looking at this bigger picture. They see a combination of stretched affordability, the mortgage payment shock, the risk of negative equity, and a fragile economic backdrop. They argue that these factors create a perfect storm that could lead to a significant and sustained fall in house prices. In their view, the market is not just cooling, it is teetering on the edge of a major correction. It's a sobering perspective, and it highlights the very real risks that buyers, sellers, and homeowners face as we navigate the uncertain waters of 2025. Despite talk of crashes, the British desire for homeownership remains strong. This deep-rooted dream supports the market, even in tough times. Life changes, new jobs, growing families. Keep transactions steady. The market bends, but rarely breaks. That's the resilience of the British property dream. The UK's housing market is shaped by a simple truth. Demand far outstrips supply. We haven't built enough homes for decades, so even when buyers pull back, prices rarely collapse. This chronic shortage means homes remain scarce and valuable, making a dramatic price crash much less likely. Higher interest rates may seem worrying, but they've helped calm the housing market, ending the stressful bidding wars of recent years. Now, buyers have time to view properties, do research, and make considered decisions. Sellers are more open to negotiation, making it a healthier, more balanced market for everyone. National headlines talk about the UK market as one, but it's really thousands of local markets, each with unique opportunities. Look for areas with new transport links or regeneration. These often offer the best value and future growth. City flats and homes needing work can be smart buys as demand shifts and prices stabilize. Ignore the noise, study your local area, and you'll find real opportunity in 2025. Chloe and Tom, a young couple near Manchester, spent years saving for a home, only to see prices soar. But in 2024, the market calmed. They negotiated, made a careful offer, and finally bought their first house. Their story shows that with patience and planning, first-time buyers can still succeed. Meet David and Susan, hoping to downsize after decades in their family home. But the market's changed. Buyers are cautious, and prices have dropped. After lowering their price, they finally sell, though for less than hoped. Meanwhile, Amina, a renter, faces rising rents and struggles to save, caught in the middle of a tough market. So, what should you actually do in 2025? There's no one-size-fits-all answer. Focus on your own finances and goals. Prepare, save, and research your area. Sellers, be realistic and price competitively. Renters, budget carefully and explore all saving options. The market will shift. Be ready to act when it does. The property market can feel overwhelming, but my advice is simple. Keep calm and carry on. Buy based on your needs and long-term stability, not headlines or short-term predictions. Don't let fear dictate your decisions. Do your research, get your finances in order, and move forward with confidence.